I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Morning, John.
Good morning, Doug. How are you?
I am doing spectacular.
Awesome. Yeah.
How about you?
I'm doing great. Let's get through this and hopefully provide some value and get out to that sunshine because it's a beautiful day.
I'm with you, man. I'm actually pretty excited about this one today because I don't know if I'm just a glutton for punishment or what the deal is, but I can't help myself. I'm on some I've been in them for a long time, financial groups on Facebook where everybody's pretty much saying the same thing. And every once in a while, just for fun, I'll throw out that somebody should maybe take a look at incorporating whole life insurance as part of their retirement plan or something like that. And without fail, I get the typical, it's a scam, Dave Ramsey said it's bad, blah, 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 blah.
Wow.
But one of the most common objections that I get, and I hear all the time, and I know you've heard it, is, well, it's a scam because the life insurance company keeps your cash value when you die. And I'm like, oh my God.
Gosh, yeah, exactly.
You don't understand
like a
this
scam to me.
Product at all. But it is a really prevalent objection. And when I first started looking into this, it was something that I did not understand either.
Mm-hmm. Yeah.
So.
And we don't talk enough about it. Yeah.
No.
Here we go.
Yeah, here we go. So this is probably not going to be a spectacularly long episode because we don't really need to go too far into it. But we're going to take a look at an example too to kind of break it down. So for those of you, a lot of you listening, you probably know the answer to this, but no, the insurance company does not keep your cash value when you die because the cash value and the death benefit are, in fact, one and the same.
Yes.
You want to explain why that is, John?
Well, it's the current value. So as you pay your premiums and dividends are paid and it grows, right? The cash value is the current, basically the current value if you were going to surrender the policy, right? Because over time, the insurance company is taking their own risk off the table, right? So that's how the cash value keeps growing. But the cash value, when this contract goes to full fruition at age 121 nowadays with these policies that we're writing.
Mm-hmm. Yeah, it used to be 100. Then people started living longer.
Yeah.
Yeah.
They jump. That tells you something, right? The insurance companies know that we're meant to live a lot longer than 100. And many don't make it to 100. But anyways, the cash value and the death benefit are the same because they become the same number at the age of 121.
Yep. Yeah, so the cash value is just the net present value of the future death benefit.
There you go. Well said.
And it is exactly like John said, as you get older, believe it or not, it is more and more likely, statistically likely, every single day that you are going to die. Not to get all morbid here, but it's just a fact. Yeah. And it becomes more and more expensive and more of a liability to the insurance company every day that you get older. And it's for a term policy, it's whatever. There's an end to the term, and they know that when that term ends, I don't know if anyone here has gone and looked at the cost to renew their term insurance, but you'll see the premium will go up like 10, 20, 30 times from what it was before, depending on your age. And then that just expires, and you just rented life insurance. And there's nothing wrong with term insurance. It's just a very different beast. Whole life insurance, it's your whole life. And so it's as long as you pay the premium, it is a known outcome that they're going to pay you a death benefit. It's just going to happen.
Yep. One way or the other.
Yep. And you're paying a whole lot more premium especially at first for that. When you look at the amount of premium you'd pay when you're 75, it would actually be a lot less than if you tried to buy a term policy at 75. So you're really kind of front loading that. And for giving the insurance company all of that cash flow up front, they're structured to give you that benefit of having cash value that you can access. And it is, like John said, that at any given point, the cash value you have is how much the insurance company would pay you to terminate the contract.
Yep.
And
Exactly.
yeah.
So it's not like your money's going away, right? I mean, it's literally sitting there for your leverage if you want to borrow against it, right? And then it's also increasing in value because there's a day of reckoning for the insurance company.
Oh, yeah. And
they've got to meet that death benefit. And these policies that we structure for the infinite banking concept, they're just continually growing in death benefit. Like the death benefit just keeps getting bigger and bigger.
It does.
It's not. In fact, you probably couldn't even get underwritten. Well, in many cases, you cannot get underwritten for the amount that would end up being paid out at age 121.
Oh,
it
yeah.
grows that big that your income couldn't support it, right? They would not approve you for that amount. That's what's amazing about this.
Yeah, it is very cool. They do get much more efficient as time goes on. And a lot of people, I don't think, understand that either, that they have this fundamental idea that the death benefit and the cash value are somewhat separate, and that you cannot have cash value without the death benefit. I've had people ask me, well, I just want a policy with no death benefit. It's like, no, it doesn't work like that, you know?
Yeah.
And that's why it's always going to be underwritten as a life insurance contract. That is the primary reason that the insurance companies issue those.
Of course.
And there are policies, whole life insurance policies that they issue that have a static death benefit that doesn't go up, and they will be less expensive generally. But what we work with are policies that they're going to issue dividends, which cause the death benefit to go up, and also the cash value.
Yep.
It's in tandem, right?
Absolutely. Yep.
So when we hear this argument that, well, the life insurance company just keeps your cash value, well, let me just throw out an example here, okay? So I pulled up my son's policy. So these are real numbers that we're looking at. It was issued last year when he was 3, and we pay $6,000 a year in premium for our son. Okay. So currently, he has, and I'm looking at the illustration. It's actually a bit more than this.
Yeah.
He has I want to say $3,500 in cash value.
Okay.
Right now that he could take out.
Yep.
Now, and again, my wife would kill me if she hears this. I'm knocking on all the wood right now. I'm not trying to be morbid. God forbid something happens. This policy would pay out $1.25 million.
Okay.
So would you rather have $1.25 million or the $3,500 in cash value?
Exactly.
One is better than the other.
Yeah. I'll just take the cash value. I want one of those policies.
Yes. And so
who would dream of that if they really looked at and understood this, right?
Yeah. And people just completely overlook the value of the death benefit here. I mean, and talk about an unbelievable rate of return.
Yep.
I mean,
exactly.
You simply cannot beat that. And go read some of Brian Bloom's books. He does a good job of talking about this, but that death benefit is non-taxable.
Exactly.
When you're looking at a lot of other windfalls that might come in to your life,
a
lot of times you're not getting exactly what you think you're getting. You're going to pay a lot of taxes on that. There might be a lot of hoops to jump through. This is just a check shows up.
Yep.
There's no burden, no obligation there.
Yep.
Yeah.
They just send it to you.
So let's go out a little bit further, right? If we go out to, and he's age 40, and that's going to been 40, 36 years. What's 36 times 6,000? Like 200 grand? Something like that?
Yeah, like 216 or something like that.
Yeah. Non-guaranteed cash value, $2 million.
Yeah. That's a little bit like printing money. I mean,
yeah.
You're talking cash value.
Oh, no, sorry. I'm looking at the wrong column there.
Okay.
$500,000. Death benefit, $2 million.
Okay. Yeah.
Really good.
Yeah. I like the cash value.
Yeah.
Because now this guy's 40. He might have started a family, this little boy of yours.
Yeah.
And he can do things. And he's been doing things. He's probably been doing things since he was 15 and a half, when his dad takes him to that parking lot to take a ride around in the car for the first time. And he's like, oh, I got the fever. Now I can think about a car.
Yep.
Wow. Well, we've got a bank account for you.
Yeah.
And
down payment on a house. Yeah. There's a lot of things that you can do.
So he's doing this stuff all the way through. This isn't like waiting.
Nope.
This is doing what people do, but they typically go to another financier. And now you're the financier. Mm-hmm. And then you recoup it by being the honest banker. I mean, it's just,
Yep.
You obviously know, everybody that's listening, that we love talking about this.
Yes.
I feel like I'm repeating myself over and over and over.
Well, just wait. Just wait. So, 70 years in, he's 74 years old. The, again, projected cash value, and John and I have talked about this. We're not, we can't tell the future, but this is all projected on interest rates that were in force in 2022 when they were quite low, and they've been going up. So we don't know what's going to happen. Historically low interest rates, but again, projected off the interest rates and the dividend rate at the time that this was issued.
Yeah.
Okay. So the cash value, having paid $420,000 in premium, he's 74 years old, $3.2 million and $4.5 million in death benefit.
Yeah.
Okay. So you see that these numbers, like before we were at, we had paid about $200,000 in premium, and I'm sorry, I'm like, it's too early. I was looking at the wrong column. So when he was 40, when he was in his 40s, it was actually 600 something thousand in cash value, $2 million in death benefit, right?
Yeah.
As he gets older, they get closer.
Yeah.
3.2.
Yeah. Just keeps getting closer.
And then when we get out to, 96 years into this, he's 100 years old. This policy's fully paid up, $465,000 in premium. What do we think the cash value is going to be?
1.6.
Well, no, it was 3.2 before.
Oh, geez. What am I saying? Wow. Really? The cash value?
Yeah.
See? Even me.
Yeah.
It's crazy. Probably 4.9.
8.8 million.
What?
Yeah. Yep. 8.8 million, $9.5 million in death benefit.
Gosh, I wish I had started this much earlier in my life.
And then what happens when we go out to age 121, these things both meet up at exactly $17,169,821. $17 million for having paid $465,000 total in premium, and that premium amount will never go up.
I'm cautious at times, right? Because all we're talking about is money, right? But that's the world we live in. It's not all about, stuff, right? It's about our life experience as a human, an evolution, a positive evolution of our soul. But when we do talk about the things that you might want to experience in life, and maybe money will help you have those experiences.
Sure.
I mean, whether it's just traveling the world, being in different places that you wouldn't go to see things, presentations, maybe concerts of any sort, anything, right? But also, if you did want to invest in various things that were cash flow producing assets. I mean, do you think this is going to be worth, like you said, at age 40, it was 3.2 at age 40?
No. At age 40, the total death benefit was around $2 million.
Okay.
And it had, like $500,000-$600,000 of cash value.
Okay. So between 40 and 74, which was the other number, right? Which was when you went to 3.2 million.
Yep.
Right. The difference between that 600,000 and and the 3.2, all those days there was access or availability of this cash value for you to leverage.
Yes.
Every single day it was growing.
Yes.
So, and you were able to leverage it. Do you think that maybe you bought something that then produced more value?
Yeah.
So it's not just the 600,000. It's not the 3.2. It's not the death benefit. It's all these things that life experiences that you could afford, and then maybe producing. So, returns, when people start talking about the returns in these policies, like looking at the number, you're missing the big picture.
You are missing the big picture. And there's a peace of mind factor that people don't think about. Like, to have this base that is always there, so you can go F up whatever else you want to do in your life, like financially. You could go take more risks. You can do this and that. And at the end of the day, if you screw up everything else, you have this to fall back on. And one of the biggest stressors that people have in life is money. Yep. And a lot of people don't want to engage in certain experiences in life because they're afraid that they can't afford it, or that they should be saving more for later. And they then go tie up a bunch of money to be used, decades down the road, when that future is not secured, right? We don't know what's going to happen. And they forego living life in the present because of financial insecurity. Yeah. It is a very real thing. And I lived like that for a long time.
Yeah.
And my wife and I really wanted to set our son up differently to, like we talked about in another episode, to have that tailwind behind him for his whole life.
Yep.
And, this is about just being able to move through life freer.
Yeah.
And having less insecurity.
Yeah. Well, when we talked in another episode about the programming and then your son asking a lot of questions about money and wanted to understand it, and how you and your wife, his mom, try to be really cognizant of the words that you choose in explaining things, right? Because so many people were told the reason you can't have that right now is it's too much money.
We can't afford it.
We can't afford it.
Yep.
It's too much. And if you're in that theta state of, the first 7 years, man, that's programmed. That's the reason why. It's not, the reason is we don't need more stuff. You have enough toys or things at home.
Right.
That would be maybe a better answer. I'm not saying, right? And I'm sure I probably use some of this language with my own 3 children.
Yep.
And so many different things can happen, but that's a scarcity mindset, which we're programmed to believe.
Sure.
That's too much. We can't dream. We can't just imagine what we want to do, what we want to experience, because, that's going to cost too much money and I don't have it. Right? So we're trying to provide the knowledge that if you do things slightly different, just reverse things a little bit, make yourself the banker first, that you're the profiteer of that, and then the reuse of that money over and over, that just is going to change how, it's going to minimize the stress, because as you say, it's the mind, it's the mindset, and all of a sudden you're like, this is not as big a factor in my life, in my relationship or relationships, right? With my spouse, with my significant other, with my children.
Yeah. And it's like, okay, this unexpected thing came up. I've got the cash.
Yeah.
Exactly. I got the cash. It's there. It's safe. It's always accessible.
Yeah.
So, cool. So the takeaway here is, if you hear somebody telling you, well, whole life insurance it's bad deal because they take the cash value when you die, you can assume that person fundamentally has no clue what they're talking about. Right. And I hope that the example of the illustration, despite my bungling the numbers at first, was helpful.
Yeah. And me too. I was bungling.
Well, it helps to see it and understand. So again, just to just to kind of like go over it very briefly, like in the beginning, you're going to have far more death benefit than cash value. Right. And it's a very large disparity. So my son's policy, $6,000 in premium paid year one, a little over $3,000 in cash value, $1.25 million in death benefit. We go 40 years in, you got, you have a little over $500,000 in cash value, $2 million in death benefit. So you see that gap closing. Mm-hmm. And then we go out further, and it was $8.8 million in cash value, 9.5 in death benefit. And then when we get out to the end of the life, they both match up at a little over $17 million. And so that is the way every contract is going to break down somewhat. I mean, it's going to have that disparity at first, and they're always going to be growing closer together because they are, in fact, one and the same. And the cool thing about the insurance contract is that you have this death benefit that acts as legacy protection. It's paid out to your heirs, and you are able to utilize it while you're alive. It's very interesting, actually. And also, kids' policies are very powerful. I think these numbers show that. Yeah. So if you guys, if anyone listening here wants to set one up for their kids, please reach out to us. We're very passionate about setting these up for children. They're more impactful. I mean, the younger you can set these up, the better they are. And I mean, the best time to set one of these up is for a child.
Yeah, so I agree.
You require far less premium dollars to accomplish, a result.
And that just changes everything.
Yep.
For your family going forward.
It does. Yeah.
Yep.
Thanks, John.
Hey, thanks, Doug. This is great.
Yeah, man.
Thanks.
See you next week.
Let's go get some sunshine.
That's right. Vitamin D?
Yes.
Okay.
So I've been told.
Talk to you soon.
All right. See you, Doug.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.